We have a very important video today, folks. Inflation dropped to 5%. There's a lot of things to cover. So we're going to talk about that in this video. We're going to talk about best case scenario, Fed pivot, the big misconception. You want to stick around for this part because there's such a huge misconception about the Fed tightening and loosening monetary policy. I'm going to break that down for you. So you really want to see that part and how, again, it's going to affect real estate, mortgages, crypto, and stocks. So stay tuned. This is going to be a good one. It's going to be jam-packed. Okay, so inflation dropped to 5% year over year. In our previous month, in February, inflation was 6%. So a 1% drop is huge. Very, very good news. Jerome Powell is doing a little bit of happy dance under the table because his Fed aggressive rate hikes are working. We're heading towards our target of 2%. So what's the best case scenario? Now, of course, there's a chance if rates continue to come down at this pace, we may be reaching our goal of 2% inflation in the next few months, which would be amazing news. But is that going to happen? If inflation drops 1 full percentage point for the next 3 months, we're out of the woods. But that's the question. How sticky will inflation be the lower we get? So that's the main question. The one analogy that I keep hearing is that of weight loss. Okay, so when you're on a weight loss journey, the first 5 or 10 pounds come off very easy. It's the last 5 or 10 pounds that become much more difficult. So that's the analogy that I keep hearing with inflation. Once we get into the lower ranges, it's going to be harder, but we'll see. On the flip side of that, we've never seen this aggressive rate hikes, and they might be getting the job done quicker than anticipated because the amount of rate hikes we've seen in the last year is unprecedented. We have not seen this before ever. So what are the chances that we'll see a Fed pivot this year? Now, if we look at the Fed Watch tool here, they're still predicting a 0.25% interest rate increase at the next Fed meeting, which is scheduled for May 3rd. So please, if you find value in this video, please like and subscribe, and I'll keep you guys posted on what's going on in these meetings and how it's going to affect all of the markets. So please subscribe if you find value and hit the like button. Really, really, really appreciate it. So we're still expecting, the market is still expecting a 72% chance that we have a 0.25% rate hike. Let's refresh this to see if anything's changed. 74%. Okay, so just in the last couple minutes, the market is still predicting a very, very strong chance that the Fed raises rates another 0.25%. In my opinion, even if this happens, which I don't know for sure if it will, but even if this happens, I don't see any more rate hikes after May 3rd. I just don't see how, that would be happening with inflation coming down, the banking crisis, all of these things happening. I think this will probably be the last one. So stocks let's get back on the screen. Stocks and crypto have not really moved yet. It's 8 in the morning. I did get my first mortgage update from one of my lenders. Rates have improved for mortgages, and my guess is they're going to continue to improve as inflation comes down, which is going to make the real estate market more competitive. If you're looking to buy a home now, if you're in the market now, I would try to buy as soon as possible because as rates come down, competition is going to ramp up. I mean, I'm a real estate broker, mortgage broker, and I have dozens, just myself and my team have dozens of home buyers that have told us we're going to wait till rates come down. Okay, so if that's just my small team of realtors and lenders that are hearing from dozens, probably 30, 40, 50 people have told us collectively, we're going to wait till rates come down. Just imagine the number of people across the country who are just waiting for rates to come down, which is going to cause a lot more competition and a lot higher prices. If you didn't see my last video, check it out. I talk about how median prices throughout the entire Fed rate hike of 2022, median home prices have not dropped. So I know there's a lot of FUD out there about a housing market crash. Don't believe it because it's just not happening. Again, it depends on where you live. The city, county, state, region of the country, everywhere is a little bit different. But overall, housing is not coming down. It did not come down during the entire rate hike of 2022. So be careful of who you're following and watching on YouTube. You may be duped when you find out home prices are not going to drop 20 or 30%. One other thing I want to mention about home prices. I know sometimes you'll come across a listing or other YouTubers show listings with 100,000 price drop, 200,000 price drop. This does not mean home values are coming down. All that means is that we had a seller who had very unrealistic expectations of what his home was worth. So yes, if your home is worth 700,000 and you list it at $1 million, of course you're going to eventually have to do a price drop because your home was never worth $1 million. So it's a very misconceiving thing. When you see those big price cuts on Zillow, that doesn't mean home values are coming down. That just means you had an unrealistic seller. So let's put that aside for now. So what is the big misconception that I talked about in the beginning of this video? The big misconception is that quantitative easing is gonna cause inflation. So if the Fed pivots and lowers interest rates, we're gonna see inflation ramp up again. I'm gonna disprove that in this video right now. So let's take a look at these two charts. Sorry guys, wrong screen. All right, first chart. This is the Fed funds rate over the last about 20 years, okay? This is what interest rates and quantitative easing has been over the last 20 years. As we can see, we had the recession, we had the housing market crash of 2009. From 2009, or 2010, let's call it, from 2010 up until the pandemic of 2020, for the majority of that period, rates were at near zero. 2009, near zero. 2010, 2011, 12, 13, 14, 15. That's when rates ticked up a bit. The Fed's fund rate peaked at 2.4 and then came back down a little bit. Before the pandemic, rates were low. Okay, for a 10-year period, for majority of that period, rates were near zero, and even, when they were raised a little bit, 2.5 at the peak. So that was the Fed funds rate. That was quantitative easing. Now, let's look at inflation. From 2010 to 2020, during that same period, inflation was almost always under 2%. Under 2%. There was a little blip here in 2000, maybe 11 or 12, where inflation got a little bit above near 4%. But for the majority of the time, inflation stayed around or under 2% during that whole time where we had rates near zero. Now again, when we hear quantitative easing, okay, or the Fed printing money, can you tell me the last time the Fed printed money and money just showed up in your bank account besides COVID? It didn't happen. Okay, just because the Fed prints money or lowers rates, it doesn't mean that you automatically get money. Okay, so it's a big misconception. The only reason we have this inflation issue is because of the government, because of the Biden administration and what they did, shutting down the entire economy and then giving free money to tons of people. That was, again, unprecedented. So PPP loans, double or tripling the unemployment. So I don't know if you guys know this, but during COVID, normally when you get unemployment, if you're a W-2 employee and you have contributed unemployment tax over the last several years, and if you have a W-2 job and you've been contributing, you get about $1,800 a month. During COVID, anyone who was self-employed, who never contributed to unemployment, received not the regular $1,800, a month of unemployment, but got nearly $4,000 a month. So that's free money, the PPP money, plus shutting down the economy. That's the reason we're here. It has nothing to do with quantitative easing. Another example of how quantitative easing doesn't cause inflation is Japan. Japan has been in a quantitative easing near 0% rate environment for the past, I don't know how long, for a very, very long time. And you're never hearing about any type of inflation over there because that's not the culprit here. The culprit was the government and the stance they took during COVID, shutting down the entire economy, shutting down restaurants and malls and theaters and every small business you can think of, plus the amount of free money that was given to people through the PPP, unemployment, and other loans. And that's the reason we're in the inflation environment we're in today. Not quantitative easing, not low rate environments. It's just not true. It's right there in the charts. The charts do not lie. So lastly, once we have this rate Fed hike pivot, once they stop and eventually inflation comes down, they're gonna have to change course. They'll start lowering interest rates. In my personal opinion, I think that'll be later this year, very early next year. And that's where we're going to see a really bull run in the stock market, Bitcoin, crypto, and as well in the real estate market. It's just inevitable, especially when rates come down. So if you found value, please like and subscribe. Thank you guys so much. I'm going to keep updating you guys on what's going on after all these meetings, everything, including real estate, mortgage, a little bit of crypto content. But my main channel here, we're going to be talking about the news, what's going on with this inflation, mortgages and real estate and the market. So thank you guys, and I'll see you on the next one.